Hey, it's Ken Perry with another update for you. Things are crazy right now, and so the more updates we can give you, the better. I had Matt Graham in studio again today. We were filming some 2023 continuing education for loan officers. And anytime I've got Matt in, I want to put him on camera and just chat about what in the world's happening. Today, and as we film this, it is Tuesday the 13th. The CPI came out, and it's a little bit wonky. Talk about it.
I think that your crew scheduled me to come in today on purpose because CPI was coming out.
Yeah.
Thinking, oh, hey, maybe something crazy will happen and we can talk about it after.
I promise you they didn't know CPI.
I mean, if they did, that was brilliant. Give them a raise. Good planning.
It could be.
Yeah. In fact, don't give them a raise because the Fed wants to see wages coming down because inflation is too high, which is something we learned in today's CPI report.
Wow.
So, today's CPI was a decisive moment in some regards because we're in the process of figuring out what's going on with inflation. Mm-hmm. We know it's really, really high. Mm-hmm. We know it was going higher and higher into the middle of 2022. We know the June CPI data really hit bonds hard, hit rates hard, sent rates moving way higher. But then things started to cool down a little bit. Economic data cooled off in July. There was a big drop in headline inflation. And for viewers at home, headline refers to the overall level of the consumer price index, whereas core inflation strips out the more volatile food and energy components. Mm-hmm. The Fed is more worried about the core. So headline inflation may have dropped all the way down to 0%. But core inflation today was expected to come in at 0.3%. Remember that number. Okay. Because the actual number was 0.6%.
Twice what they thought.
A massive, massive beat on the core level. Yeah. So when you are waiting to find out whether high inflation is done, or whether we were just maybe getting ahead of ourselves in July and your core inflation comes out at twice the expected amount, it's not good for rates.
Yeah.
And it wasn't good for rates today.
So they just got pounded?
The nice thing is, well, I guess nice is relative. It could have been worse if you were a short-term rate, like a 2-year Treasury yield, because the primary effect that high inflation is going to have on the rate landscape is going to be first and foremost on the Fed funds rate. Mm-hmm. It's going to tell the Fed we got to hike even more. And those
again?
Yeah, they're hiking again. We already knew they were going to hike.
Yeah, totally.
We already knew, and it's probably going to be 75 basis points. That was highly likely before today. But after today, and this is something that I told my crowd on MBS Live even before it happened, was if we have a big beat in CPI, expect people to start talking about 100 bips. That's on the table now.
A full percent.
Yeah.
On short-term rates.
And in the morning, it was like right after the report came out, it was like 18 to 20% odds. Yeah. By the afternoon, it was up to 30% odds of 100 bips hike. But I'll tell you right now, what matters is the rest of the data that comes out between now and next week. If it is, strong for the economy, it's further going to increase the odds that the Fed at least talks about 100 bips. And if the market gives them permission to do it by pricing it into Fed funds futures, they'll definitely hike that much if they can get away with it. And if they don't, it will be an important window into Fed Chair Powell's soul. He'll be telling us, I do think that our policy is probably going to have the desired effect without having to be quite as aggressive as we've said. And markets might read that actually fairly favorably. But to get back to the point I was trying to make is short-term rates are going to be more effective. They're closer to that Fed funds rate, which is an overnight rate. So 2-year Treasury yields, 3-year Treasury yields, those rose much more rapidly than a 10-year Treasury yield and a 30-year Treasury yield. In fact, 2-year Treasuries, I haven't looked because I was recording with you, but they were up 15 to 17 basis points on the day in terms of rate. And 30-year bonds at the same time in positive territory. They had actually fallen on the day.
Really?
Yeah. That's yield curve inversion.
All right.
So those longer term rates, investors have to think, what's going to happen over the entirety of the next 30 years? Is it going to be worth whatever we're doing to get inflation to come down, or is that going to hurt the economy and bring inflation down ultimately? And so investors are really saying, yeah, I don't see these returns staying this high over the next 30 years, but I definitely see over the next 2 years, short-term rates remaining elevated while the Fed does what it needs to do to fight inflation.
And this was a weird day because stocks and bonds both dropped.
Yeah, great point. And that's the classic Fed accommodation trade, as we call it, which is a lame term. You should help me come up with a new one. But when I say it...
That's fat. Fed accommodation trade?
Yeah, really fly.
I mean, the acronym.
Oh, I thought you were just saying it was.
That would be PHAT.
Yeah, okay, yeah. Fed accommodation.
Really fly.
Yeah. My kid makes fun of me for saying fly.
It's still rad.
It's very rad and dope, but we digress. So the Fed Accommodation Trade, or FAT, if you will, coined by Ken Perry. This turns the normal correlation between stocks and bonds that people think exists on its head.
Right.
Because normally you think interest rates are going to move the same direction as stocks. Right. And many times over an intraday time frame and even over multiple weeks, you can see stocks and bonds move in the same direction. When the market gets a piece of information that greatly affects what the Fed is going to do with monetary policy, you will see them go in opposite directions, like an ink blot, like a Rorschach test. Mm-hmm. And that's exactly what happened today. Bond yields shot higher, stock shot lower, because the Fed is the rising tide that lifts all boats. Mm-hmm. And if the Fed is actually raising interest rates, that is a tide that crushes all the boats on the rocks and everybody dies, and it's horrible.
All right, that's exciting stuff. Woo! What's causing all the inflation to continue?
That's a topic of great debate.
Yeah.
And it's not something that I can comment definitively on.
Yeah.
I will say, there are supply reasons for it. Mm-hmm. We know about those. We've heard about those. Mm-hmm. Certainly.
Somebody said supply chain to everybody who's watching this right now at some point today. I hear it everywhere.
At least 3 times.
Yeah.
There's certainly demand component,
Right.
When joblessness is as low as it is right now and wages have grown as fast as they have, even though wages aren't keeping pace with inflation,
right.
Things are good. If you need a job, you can get one. You can,
right. Can you get a good job right now?
That's a great question.
It feels like every job available is at a restaurant, which is a fine job.
No,
we all should do it at some point in our life. But
I did it.
I did too.
Red Robin.
All the best people did.
Yeah.
But are there great jobs out there?
I'm not an economist, but the consensus among the MBS Live community is that things could be better in terms of the jobs that are available.
Yeah.
If you have the right skill set,
Mm-hmm.
and you can find the job for you, great. But when people say that job openings are at an all-time high or that unemployment is at a multi-decade low, then we have to consider the fact, a certain number of people are out of the workforce after COVID, and we also have to consider the quality of those jobs. Mm-hmm. And they're not necessarily as high as people would want.
Right.
In my opinion, based on anecdotal comments.
One last thing, and I don't know if you want to comment on this. I've stayed away from it completely, but let's just have a logical and reasonable explanation on this. Student loan debt.
Oh, yes.
The effect of paying down that student loan debt, would that not give people more money to dump into the economy? Would that not trigger more inflationary potential?
Yeah, it definitely could do that on the margins, but I think that is not a key driver of hyperinflation or concern. And we also don't really know exactly how it's going to play out.
Right, right.
No strong opinion on that.
Yeah, but you're keeping your eyes on everything.
Yeah, I mean, realistically, economic data is critical because the Fed is looking to see how much damage it's done to the economy before it starts to ease up. But it also needs to see inflation fall under control. And the big mystery is how much of that inflation is due to the demand side of the equation, which is something the Fed can actually impact, and how much is actually due to those supply chain considerations that we all have heard so much about. So,
all right, let's leave off with mortgage rates. So they got better?
They got better.
They're still amazing?
They got better if you like high mortgage rates. Yes. So no, when I left the office to come see you today, rates had matched their high from June 14th, 2022, which was the highest level since 2008.
Wow. Still great rates. Still not horrible.
Yeah, I mean, look, I always tell people, and I have clients that tell people, if you need to live somewhere, there's no reason not to buy a house.
Right.
Right? If you're going to pay a monthly payment
Yeah.
to live somewhere and you can afford where you live and you have a job and all the rest of it, there's no reason that people shouldn't participate in the housing market.
Yeah.
But having said that, the Fed would like to cool things down as far as the exuberance is concerned, and the investment properties and the second homes and all that.
And every loan officer right now is going, it's a little too cold.
It's a little bit.
They definitely
Yes.
cooled it off quite a bit. A lot of realtors have a lot of listings on the market right now.
It's a time for pain.
Yeah.
It's the sad truth. And Powell will be the first to remind us of that next week at the Fed announcement and the post-announcement conference. But they have said time and again, hey, America, we're sorry. There's some pain coming your way. We feel like we need to do this to fight inflation. And it's going to be better in the long run if we do it now as opposed to just see how it plays out.
So that's the good news, is that we can anticipate more pain in the short term so that we don't have long-term pain. He's trying to just shut it down and act as fast and as big as he can. He's really making a name for himself.
Yeah. Two different names. One was Powell, and now it's Volcker. Volcker 2.
Volcker 2. All right, well, dude, thanks for swinging by.
Great to be here, Ken.
There you go. There's your quick update. We'll see you next week.